So, James, before we begin, I do have, well, really two very important questions to ask you.
Okay.
Uh, and I'm sure it's a
Question number one.
question. I'm sure it's a questions that many of our listeners are also interested in.
Okay.
Number one is, what the heck is real estate financial planner? And number two, why should any kind of professional service provider care?
Wow, those are actually not easy questions to just kind of roll up and throw it in here. So I will do my best to answer that. So real estate financial planner, if you've ever met with a regular traditional financial planner and you happen to own real estate, it's historically it's been a pretty disappointing meeting for most cases. They're really amazing financial planners in general, really amazing at kind of giving you a plan based on stock markets, bonds, Social Security, any type of like securities type investment, insurance, cash flow planning. But my experience and the experience with everyone I've ever talked to with financial planners and how they deal with real estate is they will go ahead and just list the real estate that you owned as an asset and the mortgages that you have as liabilities. And that is the extent of the planning that they do with their real estate holdings. And so I'm a real estate broker here in Northern Colorado. And one of the things that we've been doing over the years is sitting down with clients and talking to them about their kind of plan for real estate investing and how many properties they want to buy. And so over time, much more concentrated in the last few years, is we started developing software that allows us to model both stocks and bonds and real estate all in the same kind of like software planning model to be able to say, so you have $100,000 or $1 million or $10,000 or whatever it is that you're starting with right now, and it's in these different types of accounts. What happens if you start buying a property every year as a rental, or what happens if you buy a property as an owner occupant, you live there for a year and you convert it to a rental, or any variation of those types of things, and being able to see how all of it plays together, not just your stock market holdings with safe withdrawal rates and things of that nature, but also the real estate with the cash flow you're getting from the properties and equity you've got building up and appreciation. And then also on a more extreme matter, and we'll discuss this in office hours over time, is the ability to do Monte Carlo simulations with both stocks, bonds, and real estate all at the same time. And so there was a huge gap when we looked at the marketplace, and this is intended to fill that gap.
See, that was an easy answer.
That was easy? It didn't seem that easy. It's like you didn't set me up very well for that. And so, I'll mention a couple things. Number one, is this the first professional office hours we're doing? The software has sort of had a soft release doing that. We're the couple days before the Super Bowl, and I just want everyone to know, I'll show it in the camera here, that I am not a fair weather fan. I am drinking out of my Broncos cup and, wish the Broncos were in the Super Bowl. However, I want everyone to know so that next year, or the year after, when they do make it back to the Super Bowl, people say, oh, yeah, that James guy, yeah, he is a true fan. He was not a fair weather fan and decided to abandon his Broncos in one of their worst seasons in a long time.
So what's the Super Bowl? What are the Broncos, and what is football?
Very funny. All right, so let's get back on track. And I apologize to everyone. I do have a small cold. There's like some flu going around with this polar vortex coming in here. And so if I seem a little loopy today, I apologize in advance.
No worries. So now that folks have a little bit of an idea of what the software is, what we're talking about, a lot of folks that are going to be attending these office hours, they are service professionals, right? And yes, they have clients, and it is obvious that they can use the software to do financial plans, but it's also a marketing tool
yes,
in a lot of ways. So can you describe, and I'm personally very excited about, as a marketing nerd, the marketing aspect of this, but it has multiple uses. So could you give us like the high level overview of how a professional service provider, the different ways they can use the tool?
Sure. And by professional service provider, I mean, we're running a wide range of people that can find this software useful. Accountants, CPAs, enrolled agents, estate planning attorneys, real estate agents, mortgage brokers, financial advisors themselves if they decide they want to start offering real estate as part of their comprehensive planning. So, yeah, I mean, the intention is to give people the tools to be able to go and do the analysis themselves. But the fact that you have the ability to do this type of analysis gives you a very unique selling proposition, a huge marketing advantage over everyone else that is not offering this level of service, because there is a gap in the marketplace. Is that there are a lot of real estate investors out there, and you have some really interesting stats, which I suspect you're going to get to here, about how many real estate investors there are based on tax returns. But there's a huge number of them, and we will allow us to go and create either blog posts or videos of you demoing the software, or just adding it to your service offerings and including it as that, or reaching out to your existing clients. I met with a financial planner the other day, and he told me he was also his family, his dad is a CPA and runs a little tax office. And he said, I want to go and, with my dad's permission, reach out to all the guys that have, is it Schedule E? Is that the one where all the
Yes.
like real estate's on? So he wants to reach out to all the Schedule E clients and let them know that he can offer them real estate financial planning now as well. So go back to his existing clients and offer an additional service and, help them understand the pros and cons. I mean, it's not all positive. There's definitely some downsides of holding real estate, and kind of helping them understand the benefits and risks of doing that. And, the more rental properties they have, I think, I'm not a CPA, but I think the higher the tax return cost is for them. And, real estate agents can do more transactions, the lenders can do more loans, and so on. So is that sort of what you were thinking?
Absolutely. Absolutely.
Yep.
Okay.
Yeah.
Good.
And so, and by the way, just to kind of give people a framework of what office hours are, is our intention is to make these recurring and to cover different areas of the software. If we don't have specific questions, we will go and demo a particular feature that kind of says, okay, you have a client come in and does this. We'll kind of walk you through that. But really, if you have a question about, does it do this, or how would I model this for a client, or, I need to have some confidence before I start marketing it, that's what the intention of office hours is. So it's intended to be interactive. It's intended to educate you on the technical aspect of being able to use the software, and then also to deal with some of the marketing side pieces of, how are you doing this? What are you seeing is working? What's not working? And so on. So.
Absolutely. The other thing I wanted to say is that you mentioned that this is an in-house developed thing. James has coded this entire thing himself,
which is good and bad.
Right.
So if you like something, I did it. If you didn't like something, then we had some other people somewhere else sort of involved with that, which looks a lot like me.
I think it's a good thing because much is the same way that in the early days of Canopy, which is a tax resolution software platform, I was an advisor to them, and I helped guide the development of that software in the early days. You are allowing not just me, but other people to do the same thing on Real Estate Financial Planner.
Yeah, everyone can make an account. So, like, if you're on this call right now or you're listening to the recording afterward, you can go on there and make a free account. And the free account is unrestricted for one scenario. So there's no, feature set that really is limited, except for Monte Carlo, which I'll talk to you about here when we finally get to Monte Carlo. But other than that, you can go make one and tell me if you see problems or things that are working well for you or not working well.
But you're very receptive to suggestions. You're very receptive. Like, we had a conversation a couple of months ago where I was talking about being able to model variations in stock market return.
And market corrections, I think, is specifically what you have.
Specifically, I was looking for you to add the ability to simulate a market correction, to simulate a 2008, 1999, 2000 type scenario that actually happened, that we actually lived through. And so you did that, like, literally within a week or two, it existed, and you're able to run Monte Carlo simulations that simulate bull and bear markets, which is awesome.
Yeah, Jason, do you want to walk through actually a market correction scenario? I mean, this is what it's all about, right? It's like you talk about a client coming in and being able to do stuff. So unless someone has a more pressing question, why don't we go ahead and just set up a really basic someone investing in the stock market, and I will show you how to model market corrections.
Go for it.
Does that seem reasonable?
Absolutely.
Okay, so basically I'm on the scenarios page in your account, and this is what it should look like when you come in there. You may not have the ability to do folders unless you have a paid account, but folders would be good for sorting things by your client. So you put John Smith in a folder, and then all of John Smith's scenarios will be in one particular folder when it's there. So I'm going to click on scenario, and what I'm going to do is I'm going to try to keep track of which episode of the office hours we're doing these things in. So I'll use this little annotation, the 1 in brackets, in order to show that this was episode 1, that we actually talked about that. That way, if you see a particular scenario and you want to go hear the audio of the explanation for it, you can go back and see that after the fact and do this. And so I'm just going to do this one. You can call it whatever you want, stocks with market correction sample. And so this is really just your own naming as to how to keep track of it. I'll do a 480 month thing. And Jason, one of the feedback we got the last time we did a little demo of this is I think we use a 60-year time horizon.
Right.
And we got some critical feedback for using that time frame. And I want to defend the reason why we did the 60-year time frame, and that is because I think that we're seeing increasing life longevity, people living longer. And there are a lot of people that are interested in the FIRE movement, the financial independence, retire early movement. And so for us to not model, a full 60 years, especially since part of this is during their working lifetime, I think would be, inappropriate for us. It would be not doing our job to be able to model it that far out. So you could argue that you could do shorter time frames, but I think some of the people on the last call assumed that we were starting with somebody who was 65, and they're like, "Why are you doing 60 years? They're going to be 125 years old." And really, that was not the intent. The intent was to show you, someone who comes to you who's 35 or 25 even, and to be able to plan for that. And so you can adjust this number of months. We're going to do 40 years for today, but you can use whatever you want in there.
Well, and I'll just add to that, as a service provider, ideally, you want people coming to you for, tax, real estate, and financial, personal finance help when they are early on in their working career, so that you, for two reasons. One, you can help them from the get-go start off their adulting properly, and to set themselves up for a good financial future. But also, it's just good business for you, because we all know that the LCV factor, the lifetime client value, is how you build a sustainable, highly profitable practice of any sort.
Yeah.
By having those clients that are going to be in your business they're going to be clients for 20, 30, 40 years.
Right. Yeah, so get them early, and this allows you to model, either people that are already in retirement, and you can set whatever date you want to do it. I'm just going to leave it at 40 years, which is the default. Effective income tax rate, you can go ahead and use whatever their effective income tax rate is for that and their inflation rate. I'm going to keep it at 3%. Mortgage rate, 4.875. We're not going to use mortgages in this particular example, so it doesn't matter. You could set whatever you want their target monthly income to be in retirement in today's dollars. So if they say, hey, listen, I need to be able to live on about $5,000 a month or $10,000 a month or $25,000 a month or whatever your client tells you or whatever you think is going to be reasonable for them, you can go ahead and set that. I'll just keep it at $10,000 for now. And then you can set your...
James, the software does inflation adjust that amount, correct?
It does. Yep. So it'll say $10,000 in today's dollars. If you're retiring, 19 years from now, it'll be different than if you're retiring 24 years from now, because it does try to keep an inflation adjustment on that number so that it takes into account you're living on $10,000 in today's dollars.
Perfect.
Yep. And we'll just keep a yearly safe withdrawal rate. These are all different options we can cover on additional calls. I'm trying to just set up the scenario really basically to show you the market correction one. And so I'll just say this is us sampling, and this is for you to keep notes about whatever you're doing. This is sampling someone investing in the stock market and having market corrections. So let's see. It's always dangerous to do live demos of software, right? Who knows if I'm going to run into errors when I do something on here. Okay, so I've saved that. And one thing I want to point out is now it's showing this 001 in this little red box. Anything you put in brackets at the beginning of a scenario name, it'll put in a red box. And so I use that as a way to kind of like group things together. And so for this one, we're going to use the 001 as this is episode 1 of the office hours for professionals. And so that's why we're using the 001, and I'll show you that. Okay. Now, basically, we have this here. So this is the scenario. And then we have the ability to add accounts. Accounts are things like 401k, stock market accounts, your bank account, any LLC accounts you want to have in there, anything like that. Properties are houses, single-family homes, duplexes, triplexes, fourplexes, commercial buildings, apartment buildings, anything that is a property goes in there. And then rules manipulate things like accounts and properties. And then goals are you tracking your ability to hit certain cash flow numbers or net worth numbers, or to see when you're able to hit functional retirement, when your safe withdrawal rate and your cash flow from the properties and the accounts you select meets your target monthly income in retirement. So those are some examples of goals. All right, so in order to do this, basically accounts, and since we don't have any accounts made already, I'm going to need to make an account and then add it here. So I go up here into accounts, and we're just going to go ahead and add a new account. And we're going to call this stocks, earning 8.8, let's do 8%, okay? Date open, we're going to leave that blank because it doesn't matter. And then how much money do you think this person needs to start with, Jason? What do you think someone should have in their account at the start? Whatever your client is coming in with, but what do you want to use for the demo?
Well, $10,000.
Sure, let's do $10,000. Okay, and then yearly rate of return, we're going to do 8% here. Now, if you want to go model variable rates of return, we would do that using rules, and we would use a rule to manipulate the yearly rate of return every month or every whatever period of time you want to do that. And so right now, though, it's going to be fixed at 8%. And so that account got saved.
By the way, we have a question from Robert. He asks, what is a Monte Carlo run?
Oh, that's actually a really good question.
The check's in the mail, Robert.
I'm going to mute myself so I can clear my throat. 1 second, okay? If I can figure out how to mute myself. Let's see here. Thank you very much. Yeah, this is a function of my cold. So Monte Carlo. So imagine for a minute that you are, you've got a client who's invested in the stock market. And they come into you and they say, hey, I want to invest in stocks and I want to see how the market may do in the future. And so you come in and you set up your spreadsheet and you model them and you say, okay, I'm doing a 8% return on the stock market account. Is that really what happens in real life? Does the stock market always give you an 8% return? And the answer is no.
Right.
And so if you go in there and you can use a rule in order to make the return that they're getting variable. So you could say somewhere between, negative 27% per year and positive 64% per year, which is almost what the real range is for the stock market. I can show you data on that. But let's say, somewhere between that with an average somewhere around 8 to 10% is what the stock market has done historically between 1871 and 2017 or so. And so if you reran that scenario, you would see that the returns each month are no longer this sort of like nice, smooth 8% curve. It's really jagged, where 1 month it's up a lot, another month it's actually down some, next month it's down a little bit more, and next month it's up, and next month it's up, next month it's up. And so you could have these kind of like jagged return numbers happening there. And if you did that once, you might see a really jagged sort of return. But if you ran it a second time, the curve would be different. It would, because you wouldn't actually get the same exact random numbers the second time you ran it. Just like if you lived in parallel universes and you got a return, one parallel universe, and then the next parallel universe, you got different returns in the stock market. They wouldn't be exactly the same. What Monte Carlo does is it pretends that you have 10 or 100 or 1,000 or 10,000 parallel universes all happening at the same time. And the returns in each one of those parallel universes is a little bit different. And what a Monte Carlo allows you to do is run all of those 10, 100,000, 10,000 different runs and then aggregate them together to show a range of what values would be over those 100 or 1,000 or 10,000 kind of simultaneous parallel universe runs. Does that make sense?
Robert, does that answer the question?
And if not, let me know and I'll try to explain it a little bit more. But for now, what I basically did is I made the stock market account, or say it's earning 8%. And then I'm going to go just run this thing and show you a little bit about what it's doing. And then once it's done running, I will go ahead and add in the market corrections. And if you're not getting the thing you need about the Monte Carlo, we can go ahead and show you what Monte Carlo looks like, and I will hopefully help you understand a little bit better about what it is. In fact, that would be a good intermediate step to us even doing the market corrections.
Yes. Yeah.
So what happens is the software actually, once you're done doing it, you click on the rerun this scenario, or it's also available here to run the analysis. And then what it does is the server gets queued up for it to run it. And it takes a little bit of time for the server to run it because it actually waits for jobs in order. And once it's done with that, it will run it. So it could take a minute or so to run, but once it's done running, it'll show us complete here, and then we can go drill down and look at stuff. In the meantime, go ahead.
I just want to say for folks that are saying, well, this is the real estate financial planner, especially folks that just jumped on the last few minutes. Why are we talking about a stock market correction? So, just really want to illustrate. A lot of professional financial planning software. This is what it does. It runs Monte Carlo analysis on retirement planning scenarios using stocks and bonds and historical averages. That's what it does. So
Yeah.
if you're running financial plans, this is actually kind of where it all starts. What Real Estate Financial Planner does is it then also bolts on an amazing suite of real estate specific tools onto the basic stock and bond type analysis.
Yeah, and if people are like thinking to themselves, this is really simple. I mean, you could just do this in Excel. Why would you go take all this time to add a $10,000 account and have it be 8% return? It gets crazy sophisticated. Okay, you can do much more stuff than Excel. I'm just trying to build on the basics, so I don't go and show you this really crazy model with required minimum distributions and buying real estate at irregular intervals and refinancing, cash out refinancing to buy more real estate. I mean, I could do all that, but I'm just starting with basics. So.
Hey, okay, so Nicole has another question about Monte Carlo.
Yes.
What do you use Monte Carlo for? What is the purpose of it?
Yes, that's actually a really good question. So one of the things Monte Carlo can help you do for your clients is it can help you show them this is the expected range of values. Instead of telling them, if you go and you invest $160 a month in the stock market and you do that for 45 years, you'll be able to retire with $6 million in the bank, assuming you get a static 8% return. What Monte Carlo will allow you to do is it'll say, okay, if you invest $160 in the stock market every month and you do it for 45 years, you will have somewhere between $3 million and $14 million, with it being 50% of your results came out to be somewhere between 8 million and 11 million. And so it allows you to do stuff like that, where it can say your probability of success, your probability of hitting your goal of having $5 million in retirement or $10,000 a month in inflation adjusted income is 60% using this particular model. Then you can make a copy of that model, tweak one little thing and say, if you buy one extra rental property, or you pay down your rental properties earlier, or you increase your savings from 160 to 250 or 300 or whatever it is, then you have a increased percentage of success for your particular scenario. And so what Monte Carlo does, it changes it from this is an exact number for where you'll be, assuming these all are fixed, to a range of values or expected values.
The way I like to look at it is that most calculators or whatnot that you're going to use, like you said, they're going to use a static assumed rate of return. Yep. But in the real world, the stock market does not return 8.97% per year. That's the historical compound annual growth rate. But that's not what it does every single year. Right. And it's impossible to predict how the stock and bond markets are going to actually perform year to year. So Monte Carlo analysis introduces this variability. And so you make it, and it allows you to introduce some random volatility into it, that the way it actually runs, the way the market actually works, and then you test it 100 or 1,000 times using different randomness.
Yes.
That's right, how I like to think of it.
Let's do a little Monte Carlo sample here in a bit. But first, I want to continue on and show you. So basically, this is the one we just ran. It shows it's complete. If you click on the little chart icon, it pulls up the charts. Okay. I'll give you a really brief overview of the chart section. This is a whole bunch of stuff to manipulate the view on the chart above. And then these are the different charts you have available. So you have charts summarizing the entire scenario, charts summarizing the different accounts you have, charts summarizing any owned properties you have, and then charts for the goals you've set. Okay. So in this case, we're just going to look at the scenario charts. And I'm looking at net worth right now, which is already selected up here. And it shows you that when you start off, you had $10,000 in your account. It's going up by like 8% per year. And so by the time you get to this point in month 480, which is year 40, you have $215,000 saved. And this is a really simple, someone starts with $10,000 and they earn an 8% return. Now, really, it's super simple stuff we're going to do here. 215 $215,000 40 years in the future is not the same as $215,000 in today's dollars. So if you want to see the inflation adjusted numbers, you click this little button here, and it now shows you that that's really like having $66,000 in today's dollars. Okay. You want to zoom in on a certain period of time. You say, hey, show me the first 2 years. You can limit the first months to show me 1 through 24 and do all that. If you want to go back to just all, you can just do all here, and it will do that. If you do all inflation adjusted, it'll show you all with inflation adjusted and shows you as a line. Okay. All right. So the reason I showed you this though is because I want to then add in a market correction to show you what happens if you have a market correction here. And honestly, since I rewrote the software, I don't know if I've tested market correction, Jason. So we're about to see something to see if it works. Okay. So what I just did is I went up to rules and I said, create a new rule. And these are the different types of rules we have. So since this is one of our first time through, I'll read you some of the different rules that we have, and then I'll show you the one that we're going to pick. So rules to buy properties. You can say buy a property on a specific month yearly. So buy a property every January or every March or whatever it is. You can buy properties when your account has enough down payment to do so. You can set up a rule that says every time I have $50,000 plus enough for another down payment in this account, go ahead and buy another property. That's a different rule. Rules that impact mortgages, pay down loans with cash flow. So if you want to say, every time I have $100,000 in this account, anything over $100,000, go ahead and use it to pay off mortgages. You can do that. Pay off mortgages in full. Basically, save up enough money until you have enough to pay off a mortgage in its entirety, and then go ahead and just pay off that mortgage in full. Recast mortgages with cash flow. Not going to go into this today, but you can go back to your bank in some situations and ask them to recast your mortgage, which will actually adjust what the monthly payment is on the mortgage, but keep the same duration of the loan. It's a way to improve cash flow if you happen to come into a $10,000 chunk of money and you want to change your monthly payment. You asked a question? Okay.
Nope.
Other rules, add or subtract from your account balance. So if you have a regular amount of money coming into your account, let's say you're getting money from something, you can go ahead and add or subtract it from there. Here's the market correction rule, which we're going to use. You can set up a paycheck or personal expenses. Like if you were going to model Social Security, you can say, hey, listen, at this date, that's when Social Security is going to come into play. Add an additional income that comes in from Social Security and put that in there. Or you could use it for your personal expenses in your job now. Rebalance accounts. Let's say you have 3 different stock market accounts or a stock market account, another account, and you want to say, I'm investing a certain amount in bonds in one, a certain amount in stocks in the other. You can use this to say, always keep my accounts at 20% bonds, 80% stocks, or vice versa. And you can use that to rebalance money across one or more accounts each month.
I'm a big fan of that rule.
Yeah, it's great for like modeling, hey, listen, I want to be 85-75 or 85-15 or 75-25 or whatever it is.
30-70, baby.
Which is 30% stocks, 70% bonds, which is unusual, by the way.
That is unusual for somebody my age, but that is my preference.
He's a scaredy cat.
By the way, I think it might be helpful for you to mention your computer programming analogy about rules.
Yeah, so in Real Estate Financial Planner in general, the software itself is like a programming language. So you need to take the time in order to become good at programming someone's financial plan. So that's the analogy we use here. Tammy's my wife, Tammy and I like to say that the software is refreshingly complicated. It's not like you're just going to a website, filling in 3 fields on a form, hitting submit, and it's pumping out your financial plan. There's really nuance to what we can do with this. So
right.
with this sophistication comes, really good results. You'll be able to see some very interesting things that you wouldn't be able to see otherwise.
Which, by the way, why I'm fairly adamant about calling this a professional, commercial type software rather than like a consumer tool. Even though there are consumer account options, but for the average person, it's just too complicated to use. Just like somebody might say that, kind of like comparing, TurboTax versus, Pro Series, on the tax prep side. There's a distinct difference between the two and who the intended audience is. That's so I personally view this as a professional tool.
Yeah. And that actually helps you as a pro, right? You becoming knowledgeable about something, that's where you can value add. That's where you can go in and you can model their scenario where it may be difficult for them and it may not be worth their effort to learn it because they're only doing it for one person. where you are learning it and you're being able to do it for multiple people. So required minimum distribution, if you're trying to model, that you have a RMD for your IRA or whatever it is, you can go ahead and model those based on lifespan. It'll do like 1/44 or 1/25 or 1/14, whatever it is, and it changes it each year.
When did you add that one? That's new to me.
That was actually one of the first features we had.
Oh, was it? Okay.
Yep. So these three ones allows you to set values on scenarios, on accounts, and on properties. So this is what we'd go and do if we were going to change the return on that one particular account, which we will do here in a moment. But let's first, provided it works, let's do a market correction. Fingers crossed, because I don't think I've run this since we did the major updates to the software. So hopefully it'll work out. So what scenario do we want to apply this rule to? So we're going to apply it to that stocks with market correction rule. How frequently do I want to run it? And so this is like, how often will the market correction happen? And so if you say, this happens about 1 out of every 5 years, it'd be 1 out of every 60 months. Okay. So let's go ahead and do that just so we can see it happening. Then which accounts do we want to apply market corrections to? That's stock market account. And then what it actually does. So this rule gets triggered if this rule gets triggered, it will reduce the property value of selected properties by this random percentage and reduce the monthly rent of the selected properties by this random percentage. That will come into effect on lease renewal and reduce the account balance on the selected accounts by this random percentage. It is intended to simulate a market correction. And you could choose which properties get impacted and which accounts get impacted. So if you happen to have an account that is not subject to market corrections, I don't know, something that you have that is not a stock market type thing. Maybe it's a bond.
Like a money market fund or something like that.
Something like that. And you could actually say that account is not going to be adjusted for. So you can go ahead and remove that if we had multiple accounts here. Or if you had certain properties that, hey, listen, I'm trying to model market corrections in different markets. I have some properties in Florida. I have some properties in Colorado. I want to go ahead and do market corrections at different intervals for different properties. You can set up 2 rules to run and do some type of sophisticated modeling like that. Okay, and so this says, so using 0 and 20 will typically give you a median market correction of 10%, but could be mild to 0 and as severe as 20% decline. So in this case, I'm saying, hey, the market correction is going to be somewhere between 0 and 20 for that. And then I could set minimums and I could do some other really sophisticated stuff here. So I'll go ahead and do 0, 20 for the maximum. And do standard deviation 5, and I'll do 0.1. When I save it, it'll show me the curve down here of how frequently and what the market corrections will be like. But let's just go ahead and run this and see what happens. Hopefully it works. Like I said, I have not tested this feature very recently since we did some major changes. So hopefully it'll work here. In the meantime, what I will do is I will start setting up the basics for the Monte Carlo by making a copy of this scenario. And right away, you will see this chart looks different than what we had before. If you remember, our net worth was really smooth. We started off with 10,000 and it kind of grew up, and I think it was like 260,000 or whatever it was. Right. You can see when we add in market corrections, if we say there's a market correction every 5 years in this case, you can see we have drops in the market value. And that's what this actually simulates. And so it allows you to go and see what happens if these are at irregular intervals, random, sometime between 0 and 6 years, and the amount that it drops is random between 0 and 20% decline.
And this is so much closer to what actually happens in the real world than that nice smooth line that you had first.
Yeah, and it may not be like every 5 years, and it may not be as severe as 20% decline, but you can go ahead and model whatever you believe to be realistic. And if your client says, hey, listen, I really think we're going to see a market correction in the next 3 years or so, no problem. You could go ahead and model that for them and say, let's say we do have one. Let's say it's random sometime in the next 36 months. You can set the rule to only run for a 36-month period. And you can say, how big do you think the decline is going to be? And you can look at what the impact is going to be to their particular portfolio and their plan, including real estate. Okay?
Right.
So you can actually model all this stuff and see that.
The other thing that I think is worth pointing out is, different folks, they follow different, experts and, different economists, different, hedge fund managers that are, putting out different forecasts, things like that. And so some of us in the crowd might be bears. Some of us in the crowd might be bulls, over any given, particular time time period. And so this allows you to basically insert into the financial plans your own beliefs, your own economic indicators that you're following, your own assumptions based on, I guess, your worldview and the experts that you follow, and that you're attracting a target market of clients that are in line with your beliefs and the folks that you the experts you follow. And so you can model this. You're not stuck like I know there's some financial planning software, you're kind of stuck using the whatever time period of historic, S&P 500 or whatever other index, and you're not it's not as flexible for being able to change some of those assumptions. So I just think from that's more of a marketing kind of standpoint thing, but being able to model that I think is important.
Yeah. So let's continue on with the demo and try to show some Monte Carlo stuff. It seems like we had a bunch of questions on that today. So what I did is I set up a really basic rule. I copied the last one. I removed the market correction rule that we ran. And instead, I'm going to add in another rule that sets the value on accounts to be random. So I'm going to run this on the random return one. So you basically have to select which scenario you run it on, which accounts you want it to do. And I'm just going to do it on the stock market account earning 8%. And what do I want to make random? I'm going to make the yearly rate of return random. And I want to actually set the random value from the normal distribution curve as value. You could do some other things, like you can add or subtract random values from a normal distribution curve so that it starts moving slightly from where it was. Or you can multiply or divide. So let's say you want it to increase by 1% or decrease by 1% or something like that. You could do that. Or you could set the actual value, which is more what I believe personally to be the stock market, is that 1 month you could have it be up 10%, the next month it could be down 2%. And so instead of having it be like moving up and down or changing by small percentages, it can be really erratic. And so I'm going to go ahead and do that. And I'm just going to pick a random range. We can go over, Jason, you and I should do an office hours where we go over the Simba spreadsheet and show people how to pull actual market data from, and just show them how to quickly pull that. But today I'm going to do -20 to +30 with a minimum of -20 to a +30. It's going to be standard deviation of, I don't know, 10 from the range, or let's do 8 or so, and then step value 0.1. And let's just see what that looks like down here. And so basically it shows you that your most common returns in here are whatever this is, 5% or so. It's sort of what the average return. So maybe this is too low for the stock market. So let's go ahead and change that. Let's go ahead and say this is 40. So now it's somewhere between -20 return in that given month or a +40% return. And by the way, it's an annualized return that is done monthly. So it's about 1/12 of this actual return. But this shows you now that the average is like 5. It's even higher than this. Maybe it's 50. All right, so we'll just kind of keep it there. Oh, this is something else. Sorry, didn't adjust this one. There we go. A little too high now. Let's go back to 40.
So just to be clear here, the numbers you're changing and inputting are for the purposes of simulating the compound annual growth rate for this stock account. You are simulating a variability that runs from as bad as a -20 correction to as high as a +40 annual return.
Yeah, and so like right down here, it shows you the -16% or so return happened 2 times when I ran it 5,000 times, and the +36% return or so happened 2 times. And it shows you how frequently certain bands of return happen. These are the most common, how frequently they are. The little gray dots are each individual return, but the red thing sums up how many happened in that range, and then the black line shows you what the average for all of them are, all 5,000 test runs, test data points. So this shows you what you're likely to see as your test values when you're doing the runs. That make sense?
Yep.
So if I go do that and I rerun it, I'll show you a couple things. So once it's done running, I'll do this. But in the meantime, I'm actually going to make a copy of this, and I'll do, I don't know, 3 copies of it, because I'm going to show you what happens with Monte Carlo. I'll rename these so that they're.
You're going to do a different number of Monte Carlo runs?
I'm just going to show you like 3 different runs because it's random and how they work. And then I will also do one that's Monte Carlo just to kind of sample it for you. I'll do 10 Monte Carlo runs. Just so you can get a feel of how these different things work. And so this I'm just showing that we're doing 10 Monte Carlo runs there, and I'll run that as well. Okay, so it looks like the first one ran. Let's go ahead and pull that up in a chart. And you can see the line before was really smooth, where the line now is a little bit like it's not smooth, like rough, right? Because the different returns happened so that we weren't getting a constant 8% return. And you're like, so James, what return were we getting? We can go to the accounts charts. We can look at the yearly rate of return and drill down and see what the yearly rate of return was for all these different things. And so you can see that it's random, but there are some that are below 0. There are some that are higher than that. I'll take off the cash one. So it just shows you all the different random returns for that particular stock market account. And it's random, right?
But it looks like it averaged roughly about 10%.
Yeah, I think that's
average it all across.
And if you look back at this, I think we were trying to use about 8% before. Let's look at net worth. Before, I think we were at 260. So this case, it ended up doing a little bit better, 378,000. Right?
That's not just a little bit better.
Yeah, I mean it's significantly better, but a little bit better in like the big picture, right? So here's the interesting thing. So let's say you wanted to compare this to another run that we did, or let's say we wanted to do it to the initial market correction one. We can go ahead and add that scenario and compare the two. So this now is showing you. It's showing you the old one that we did where we had the market corrections. We were getting a static 8% return, and now we're comparing that to the ones that was erratic with the red one. And so you can add those in there and see the difference between those two on the same chart. Okay.
So a quick interjection. What I like about this from a sales, a client sales or services perspective is that what you're seeing here, you can run multiple scenarios with different types of assumptions and show your client or your prospective client the difference in very clear visual terms, what the difference in their long-term portfolio value is going to be based on 2 different sets of assumptions.
Yes.
And this is things like this will be great little graphical inserts. Infographics are all the rage today. Charts like this are great shares on social media. They're great to put in like one page, one sheets for different services you're offering. They're great for article submissions. Like there's a lot of marketing value that you can grab and being able to create, very easily create charts like this that illustrate these comparisons is great for marketing. But also when you're sitting across from a client saying, this is what could happen if you do X, this is what could happen if you do Y.
Yeah. Let's go and drill into some other stuff that I was going to show you. So this shows you the one with the market correction. I'm going to remove the original market correction one that we did, and now I just have this sort of jagged, rough line that we did for that one. But I want to add in the additional runs we did to show you that when you do these, they're random, so the returns kind of vary. And so this is sort of what Monte Carlo does, right? Instead of actually having to make like 30 copies of it and run random ones and see like where the ranges are and see, okay, the best one turned out to be the red one. The worst one seems to be like the yellow one, although the yellow one and the orange one are really, really close. If you want to zoom in on month 720, you can kind of see what the 3. Oops, I guess I didn't go to month 720, so I guess I can't do that. I got to go do month 480. So if you go to month 480, it'll show you like the numbers for each one of those compare for just that month. But this is what Monte Carlo does. It runs multiple iterations of this over and over again, and then it summarizes it for you. So let me go back and I'll show you what the summary is, provided it ran. Yeah, so now it just did the Monte Carlo run, and it ran it 10 times. So hopefully now you can see the results summarized. So the Monte Carlo now shows you the range of values instead of showing you each individual line for 10 runs. It summarizes what's happening at any given point. And now you can see that the 1 percentile is 261, the 99th percentile is 371, which means 1% of the time it does as poorly as 261,000 at this particular month, and in 1% of the time it does 374,000 do that. And so it shows you these ranges of values to do that instead of before. Does that make sense?
Yes. Real quick, could you explain, if there is a short version of EV, could you give a little explanation about expected value?
Yeah, so I'll give you the really short version of expected value. We should do a whole office hours just on this concept alone. So if you imagine for a minute that you run 1,000 Monte Carlo runs, and you say, my range of these values is everywhere from 100 million to negative 40 million, depending on what happens in the market, what random events happen. If you take an average of each of those individual 1,000 different runs, and you average up all the values at any given point, you get a certain number. And the certain number is the average of all the possible outcomes you could possibly have. And it's technically a weighted average because each run is weighted 1/1000th or whatever number of things you run for. And so the expected value of doing that entire run is the average of all the different Monte Carlo runs. And so what EV is, it is the expected value, which is a fancy way of saying the average of all the different Monte Carlo runs. And what's super interesting about it is, let's say you have one Monte Carlo run where you decide to pay off your mortgages on your properties, and you do a whole different Monte Carlo run where you do not pay off mortgages on your properties, and maybe you even buy additional properties, but you then want to compare one whole scenario to another whole scenario and see which one is better. You can go look at the difference in EV, or the difference in the average of all the different Monte Carlo runs compared to the average of all the different Monte Carlo runs in the other scenario, and you can see which one is better or worse from different perspectives. You can go and look at the difference from a net worth perspective. You can look at what the difference is from a cash flow perspective. You can look at the difference in risk profiles. For example, you can go and look at what the ratio of your debt to your net worth is, to see like how much debt you're carrying, or how resilient your portfolio is to declines in rent, and look at the difference in EV between your rent resiliency on one portfolio and your rent resiliency on another. So you can look at a whole bunch of very sophisticated both risk profiles and also like goals like net worth, or how quickly you get to your target income in retirement, or how much your cash flow is, or whatever it is you're trying to do. And so you can go look at both those things, look at the difference in net worth or cash flow or whatever it is using EV and Monte Carlo. Does that sort of help explain it?
Excellent. Yeah. We should definitely do full office hours on that.
Yeah, and showing people what the difference is. So I'll show you. This is the net worth one where we did the Monte Carlo. I don't know if it's going to do yearly rate of return. But yeah, see, it actually shows you now what the yearly rate of return is, and it shows you the Monte Carlo ranges of those yearly rates of return, and you can look at those if you want to and see, where they are. The more runs you do, the more certain you are that your results are going to fall within that certain range too. So if you want to do Monte Carlo runs, and the Monte Carlo is very server intensive, which is why we limit it to like the premium type of counts. But Monte Carlo allows you to do 10 runs or 1,000 runs or 10,000 runs or whatever it is, and it allows you to run this thing 10,000 times, which is like running 10,000 scenarios. In fact, it literally is running 10,000 scenarios, saving all of that data in the database, and then at the very end of it, it takes a long time, but the software then goes through and summarizes each month's data to show you the range of values, the 100 percentile, the 0, the 1 to the 99th, and it kind of gives you all those summaries there. So that's what the software is doing.
Love it. Nicole has a comment here for a future office hours. So much can be done in the system. Would be nice to know how to help guide a client and not go down a rabbit hole. So much conversation can be had with this tool. So excellent comment, Nicole. And yeah, this is the tip of the iceberg. And we had to start somewhere, and so this was a good place to start, I think, but there is so much more.
Yeah, one of the things that could happen if you're trying to not let clients go down rabbit holes is perhaps you only present them a few of the charts, right?
Right.
So you and I'll show you a really easy thing you can do. You can export any of these charts. So you can decide to download it as a PNG, a JPEG, a PDF, or an SVG if you're trying to like do a print newsletter or something like that. But you can include these on a blog post. You can include these in a Word document. So if you're preparing them a small report, you can go pull the key charts that you want to talk to them about and just include those rather than showing them all of this craziness. Because I agree with you. If you go and you sit a client down in front of this, unless you are really, really good at redirecting and handling objections and understand all the nuance, this could be a very dangerous place for a professional to be. Because they'll say, hey, so what about this monthly income for retirement, or what are all these other charts? I want to go look at those. And the next thing you know, you're spending 6 hours with a client going through 90% of the charts that aren't relevant for their particular situation, or they're just really, really benign charts that you're like, okay, mortgage interest rate, yeah, that's fixed. Nothing changes there. So in this particular example, it doesn't mean anything. So to show a client that doesn't make any sense. So maybe pull out the best ones and use those to make your kind of presentation to a client and have them and summarize for them the key points. Maybe we should talk about what I think the key charts are in the future.
Yeah, that would be a really good class. Like I already have, preconceived notions about how I would use this for delivering client services and we'll talk about this in the future office hours as well, but primarily by using the goal feature and the goal charts.
Totally.
That's how I look at this as a service deliverable. And so, I would probably choose to really only show them the goal charts and probably, maybe goal and net worth, and probably not a whole lot else.
Yeah, it's interesting. I don't know if I would automatically default to just those two. I think net worth is a key one. I think some of the cash flow ones are going to be key because people are really concerned about cash flow, and for good reason. I think, if it's a really complicated property situation, maybe some really basic summaries about the properties. Goals almost definitely is going to be in there. The other thing we can do is I can have the charts sorted by the ones that are the most popular, so that instead of alphabetically, they actually show the ones that have had the most views. And so that's a sign of popularity.
I like that.
And so maybe we have a button on here that allows you to sort them by popularity, or these are the 5 most popular charts, and then people can quickly drill down into those. So.
Cesar just said, made a great comment. He says people with self-directed IRAs are going to love this, and I totally agree. That's a great observation.
So the one thing I wanted to bring up is I mentioned this earlier, but how many people in the United States have residential real estate rental property on their tax returns?
Yeah, so according to the latest data that we have available, which is from the 2016 calendar year, per the IRS Statistics of Income report, well over 10 million people have, it's almost 11 million, have at least one rental property on their Schedule E. So almost 11 million out of 154 million returns. So roughly 1 in 14 American households owns a rental property, which is a lot. That's a pretty significant number, actually.
Yeah, I think so too. All right, that's all I wanted to mention. One of the things we are going to try to do with these is make the scenarios available for you to copy right into your own planner account. That way you don't have to recreate all this stuff from scratch. You can just copy it in there and then modify the assumptions we talked about on here, or rerun it and really drill down and get a better understanding. So Holly or Jason, probably Holly, will go ahead and let us know the URLs for being able to copy these all into your account. So go ahead and create a free account on realestatefinancialplanner.com, and then I'm not sure where we'll post them, probably on the website, or Jason will be able to send it to you or something like that, or I'll send it to you depending on what list you're on, and we'll get those to you.
Absolutely. And for those asking about a replay, these recordings will be posted somewhere. We're still working out some logistics.
To be determined. They'll probably be on Real Estate Financial Planner and some other stuff.
Yeah, it'll probably be on both websites actually.
Yeah.
And so look for those there. And then I also want everybody to know that we are working on creating a suite of professional tools, marketing tools, to help you grow this particular side of your practice. So we're looking at some done for you content marketing materials, like to use as blog posts and in newsletters, things like that. Most of you that know me, I push you in the direction of doing public speaking. Speaking in front of organizations, in front of associations, in front of groups of people, such as real estate investor associations, as an example. And so every month we will be releasing a done-for-you PowerPoint with a transcript that's kind of indexed to the slides, as well as a demo of Mr. Orr here presenting that, so you can actually follow along and see how James has done it. We have a book program in the works as well, because a book is better than a business card. And so we have a full program coming out. I will be sharing details with my readers about that here literally within the next couple of days from the time we're recording this. So that will so be on the lookout for that if you're interested. And then I also encourage everybody to sign up for an account at realestatefinancialplanner.com so that you can, I know it'll be overwhelming at first. It was very overwhelming for me until James and I sat down and recorded about, was it 3 or 4 hours worth of training material that we did, that we recorded a couple months ago, to put it up on the website. And in that 3 or 4 hours, which was very similar in format to these office hours that we're doing, then it started to click, and I got comfortable with the software, just for running my own personal financial scenarios. So that's part of our goal with these classes. Is it's just like your tax software, just like QuickBooks, just like any other piece of software, Excel even. It does take some time to get comfortable with it and get proficient in it. And so sign up for an account, play with it, and even if you're overwhelmed, I think that's an okay thing. Come to these office hours calls every Tuesday, and we will get you going on that. Any final thoughts, James?
That's it. I think we're over time, so I appreciate it.
Awesome. Well, thanks, James, for being here. I appreciate you taking time out of your day. I hope you you and your wife get healthy. And thank you, everybody, for being here. I hope that this was helpful, and we'll see you next week.
That sounds great. Thank you.
Bye-bye.
Bye-bye for now.